The S&P 500 just had its worst day of 2025, erasing $900 billion in market cap. Growth stocks were sold, defensive stocks were bought, and the bulls officially in shambles, holding the bag. But had you watched my video on Wednesday, I plainly said this would happen. End of week weakness would come, and now we're down very big on the week. But now we have to ask the question, what happens next? And in today's video, that's exactly what we're going to talk about. We're going to talk about why we're about to see an incoming growth scare, where economic weakness will be prevalent, how to hedge your long-term portfolios, and what the market will do exactly next week. Everything will be dependent on Monday's price action and Friday's inflation data. So buckle up and keep all hands and feet in the vehicle at all times. You've already lost too much money this week, so don't go ahead and make the same mistakes next week. I'm going to tell you exactly what to do to make money as the stock market crash takes shape. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks fell sharply at the closing bell on Friday as uncertainty surrounding tariffs and the possibility of a slowing economy caught up to investors, igniting fresh rounds of selling and renewing concerns of a market correction. It was red pretty much everywhere. In fact, the only green we really saw was defensive sectors. Look at communications. These are considered a defensive part of the market. Look at consumer staples. Very, very green. Various parts of healthcare. However, there was some bad news in the healthcare segment with United Health, and then we saw some green here in utilities. Other than that, everything else was very, very red. We did see a couple of other staple adjacent names do well. For example, Apple. I've argued that this is a staple company for a while, only down 0.11%, and then Costco right here down 0.20%. But Walmart, Home Depot, Amazon, Meta, Microsoft, Google, Nvidia, most of hardware, all of these stocks were down in a very big way. Financials too. And we really just saw a defensive trade today. It was really just a rotation from these names. And for those people that wanted to keep exposure to equities, they rotated into utilities and staples. I mean, healthcare as a whole wasn't even up yet, down 0.51%, again on the back of United Health. And then we did also see gold outperform, relatively speaking, only down 0.08%. And we definitely saw defensives and safe havens outperform cyclicals, with the S&P 500 falling 1.73%. But we also saw mid caps fall, small caps fall. In fact, small caps taking it on the chin. Each and every segment down more than 2%, and small cap growth down 3.22%. But mid caps fell, large caps fell, in fact. However, large cap and mid cap value, these were the only two segments that outperformed the rest of the factor and size segments, but they were still red nonetheless. And really today what we saw was just a liquidation. If you have a look at net inflows / outflows, we saw outflows in the NASDAQ 100 to the tune of $4 billion. Same in the New York Stock Exchange. We saw outflows in both these assets, with the S&P 500 falling 1.71%. Now, why did this happen? There was various reasons. One of the, I think, smaller reasons was there was actually a new coronavirus with the potential to cause a pandemic discovered in China. This new coronavirus has very much the same similarities as the previous one. It's recently discovered. It's still in a lab, and we're going to see how this pans out. However, I think the big reason why the market sold today, now one of the big reasons why we actually sold off today had to do with the economic data. Now, if you actually look at the flash composite PMIs, we all actually missed the expectation, particularly the services segment right here. The expectation here was for 53. We came in at 49.7. So anything above 50 is an expansion. Anything below is a contraction. So we saw the services PMI contract. This was one of the big reasons why we saw the market sell off. Now, existing home sales, which we're going to talk about in the video, which particularly pertains to a growth scare, which I've been pretty consistent on, that could rear its head in the middle of the year. Existing home sales actually missed expectations as well, ever so slightly. And then the month-over-month figure came in at negative 4.9%. The expectation, it doesn't show it here, but the expectation was for negative 1.7%. So the month-over-month figure missed in a very, very big way. So business activity fell. The housing data, not that great. And then consumers were feeling slightly less bullish about the economy. The actual number was 64.7 versus the consensus expectation of 67.8. So consumers not feeling that great about the economy. And then we had some Fed speakers toe the party line. All in all, this was the big reason why we saw declines today. Also, President Donald Trump's tariffs continue to leave retailers and consumers stumped about what will be impacted in the coming months. We don't actually have any certainty on that. And also, leading on from yesterday, Walmart's warning on its 2025 outlook sparked, a lot of defensive buying. And that was really a continuation from yesterday. So all of these things culminating in today's trade where we saw the S&P 500 down 1.7%, the markets as a whole just liquidating, monies coming out of markets into safe havens, into the dollar, into bonds, into defensive assets, out of cyclicals, because the macro picture and earnings visibility getting a bit more foggy, relatively speaking. Now, there was also a couple of market movers that didn't help the trade today, particularly in the Dow. United Health was down 7% on a report that the Department of Justice, it's probing its Medicare billing practices. You don't want to see that, and things continue to go south here for United Health. Now, Block or Square, as you know it, was down 17%, really hampering the financial services sector after missing earnings and revenue. The EPS expected was for 89 cents. The company actually reported 71 cents. So it was a huge miss. And that is why you saw the stock getting re-rated in a very, very big way. Now, there were a couple of winners here today. Celsius was up 30%. And that's because it beat on the top line, beat on the bottom line in its latest earnings report. And as well as on that earnings report, it reported an acquisition of Alani Nu. This is the fourth biggest energy drink company in the US. So Celsius is the third biggest. They're going to merge with the fourth biggest. And, they're really going to be competition for Monster and Red Bull now looking ahead. And the terms of this deal were very, very favorable. It's a cash and stock deal. And they're only buying Alani Nu for about 12 times earnings. So very, very favorable, getting it at a great discount. And I think this acquisition is very value accretive because about half of the acquisition is being done by cash. So a little bit dilutive to shareholders, but the market telling you that they like what they're seeing with this acquisition because Alani Nu is free cash flow positive, and this is going to be immediately accretive to the bottom line, relatively speaking. Now, Novo Nordisk was also up 5% today after the Food and Drug Administration said that shortages of their popular weight loss drug Wegovy and Ozempic had been resolved. And as a result, they were up 5%. Hims & Hers Health was down 22% as a result of this. And then for everything we saw today, guys, we actually had 1,500 advances, which is crazy. 4,700 decliners. Look at this. 1,800 decliners in the -5 to -2% range. Just insane. Definitely liquidation, people taking their money out of the markets and saying, hey, I don't want part of this. At the moment, things are looking very uncertain. And we saw market momentum stall across the curve. We even lost the 150-day moving average. And right now, only 51% of stocks are above their 200 moving day. So it really goes to show that market momentum is stalled. And yeah, things not looking good. We were looking great last week. We couldn't keep up the breadth momentum we saw last week. And as a result, the only thing that's holding this market together right now is the 200-day moving average. And we'll see how this moves on. And guys, so far today, Fridays has been the worst day in 2025. When you look at the annualized returns per day, -86% here on Fridays, as well as -42% on Mondays. Really, Tuesdays, Wednesdays, and Thursdays has been the saving factor. So if we do actually get a little bit of selling on Monday, don't be surprised. We might see a little bit of a continuation. Then we should see a little bit of a lift here into the end of the week. Nonetheless, let's hop on the charts and see where we stand. So it was a very ugly day for equities as a whole. The S&P 500 down 1.71%. The NASDAQ 100 down 2%. The IWM down just shy of 3%. The RSP outperformed all of the majors, only down 1.4%. A little bit upbeat here in the extended hours. And yeah, pretty ugly day. Mid caps fell, small caps fell, and really high beta took it on the chin. Growth and value fell, with value outperforming growth by a wide margin. but still down relatively speaking. Now, we did see the dollar gain, and again, that has to go with the momentum we saw. When you have a liquidation in the market, you're going to sell assets and you're going to move those assets into safe havens. What's a safe haven? The dollar and bond. And that's why we saw a bid in the dollar, the AGG, as well as TLT. These are two bond ETFs. And then the 2-year, 10-year, and 30-year yield fell as a result because of the bid in bonds. Now, we did see gold only down 0.1%. And while gold is down, this is relative outperformance when you look at stuff like the NASDAQ 100. So we definitely saw money go into the dollar, go into bonds. We saw gold outperform, but really money really just went into the dollar, because you're selling equities, getting cash, just holding the dollar. And that's essentially what we saw right here. However, you can definitely tell it was a risk-off day because Bitcoin was down 3% as a result. So let's have a look at the S&P 500 chart. And this is where we stand right now. Now, we are still clearly in an uptrend, but we had a very, very ugly candle, as you can see right here. Now, the S&P 500 finding kind of support at the gamma flip. However, I wouldn't say you're finding support. You did see a little bit of buying towards the end of the day, inconsequential, but we really closed at the bottom part of this candle. So it really goes to show that the bears came in, took us lower, and we finished the day at those lows in the context of making an all-time high. Now, we are still technically speaking at a higher high, and as long as we're above this gamma flip, I think we should expect the market to actually find support and then continue to move higher. However, if we move below the gamma flip on Monday and then close, that could actually lead us to go to the 5880 level. Now, I do think that this level right here is going to be very, very strong support for the market. However, it really depends what happens next week. So it's very, very simple, guys, for the S&P 500. We either find support here and move higher, or we're going to break this, right? And we're going to move lower to the 5800. These are our targets, 6140, 5880. We're at a very, very critical zone. We are literally at the line in the sand as to what happens next. This is literally what I said would happen. If you go ahead and watch Wednesday's video, I said we were at the top end of the range here in the call resistance. And I said we will move lower. That is the most likely outcome. That's exactly what we did. And I said you want to buy the gamma flip, and I remain consistent on that. Monday at the close, if we are above the gamma flip, I think you want to buy, because we probably go ahead and retest the 6140 area. On Monday, if we are below the gamma flip zone, which is this yellow zone right here, then we probably go towards the 5880 level. This is our next very key level of support. So that is how I see it. Monday's close will determine what happens next week. Now, let's actually go ahead and look at what we have done for this week. So let's just pull up the SPY, look at the last 5 days, and then we're actually going to add to this the Dow Jones, the IWM, the RSP, and the triple Qs. These are all of the major gauges for the US stock market. And you can see we sort of had a very consistent uptrend into Wednesday. Then we got that Walmart volatility, and then we got all of the data we got today, as well as the culmination of all of this week's trades, and then we actually fell. Now, the RSP was the best performing index here today, only down 0.98%. The S&P 500 and NASDAQ 100 were down about the same, roughly 0.6, 0.7, 0.8% negative for the week. Dow Jones was a bit of a dumpster fire, and that was on the back of United Health and a couple of the other names in that index. Stuff like Walmart is in that name too, down nearly 3%. Very, very ugly day for the Dow Jones. And then the IWM. And the IWM, so high beta, small caps, the worst. In fact, we're looking at quite a lot of alpha generated in the RSP relative to this. That is why you always definitely want to have exposure to large caps, because when you have weeks like these, you're going to outperform, relatively speaking. Now, let's actually have a look at what we've done year to date. The IWM officially negative year to date, down 1.51%. Very, very interesting. But the other major averages are pretty good. The Qs are performing up 3.11%. The RSP in second place, just shy of the Qs, up just shy of 3%. The S&P 500, 2.6%. That's a gain. And then the Dow Jones has gained 2.44%. So, things looking still largely constructive year to date, and this pullback looking like a garden variety pullback. But like I said, with the S&P 500, guys, we are approaching a very critical level that we are at the gamma flip, the 6,000 level, and pretty much we either go up from here or we continue the puke we saw today. I think things looking largely constructive for us to find a base. But like I said, instead of predict what's going to happen, let's wait for Monday's close, see what happens on Monday, and then that's going to tell us what's going to happen for the rest of the week. The same is true here with the Nasdaq 100, although we do have a little bit of more margin of safety to the downside. So even if we do continue the selling, we can actually still find support in positive gamma above the gamma flip. So the Nasdaq 100 looking more constructive than the S&P 500. Now the RTY actually closing below the put support, as you can see right here. When we tagged it here, we didn't close below, and when we tagged it here, we didn't close below. Now it does look like a close below happened right here. However, at this point, the put support was significantly lower. So this is the first close for 2025 below the put support. And what you really want to see here come Monday is a move up very, very quickly back into positive gamma. Otherwise, we're going to see the gamma flip, the core resistance as well as the put support move lower in a very material way. And if that happens, it probably means more downside for the RTY. So guys, everything is dependent on what happens Monday. Monday's close is going to determine where we go for the rest of the week. It's literally going to be the leading indicator to tell us if we need to wait for lower levels in the S&P 500 or if we need to actually go ahead and add some exposure, looking for higher highs into the end of the week. Now, we do also have quite a number of macro data points next week. I think the macro is also going to drive the market. However, it really is going to depend on where we close on Monday, because the technicals also do give us an indication of what the macro might mean or what the micro might produce, simply because some of these big names, these hedge funds, the market movers, they have early access to the data and very complicated models that can predict with very keen accuracy what the data points might print. But for all intensive purposes, guys, this is definitely a sell-off. We are still in a positive gamma, a liquidation today. And what we really want to do is either find support right here and be patient for lower levels. I'm still constructive on equities for the rest of the year. This looks really, really bad. But in the context of everything we've seen here lately, this will probably be another sell-off. I really would love the S&P 500 to sell off to this 5880 level. If we get to this level, I would probably be a very, very big buyer for us to move higher. Like I said, I do think the S&P 500 is probably going to finish around 6,600 to end the year. So this would be a very, very good buy, and you'd probably make 12, 13% if we hit my end of year price targets. So guys, be patient in times like these. Wait for Monday's close, and then we'll make the next decision. That is the game plan looking next week. Moving into sentiment, this is the AAI sentiment survey. And guys, we saw some pretty big changes from last week. Now, looking at the last month, we've seen a pretty big uptick here in bearish sentiment, as well as a downtick in bullish sentiment. However, we did see a slight uptick, however, inconsequential from last week to this week. We pretty much stayed the same in bullish sentiment. However, what we saw was a pretty steep decline in bearish sentiment. However, bearish sentiment still elevated relative to the historical norm of about 33%. Pretty much what we saw this week was a lot of people move into the neutral camp based on all of the volatility we've seen, valuations, what's happening with geopolitics, Europe, tariffs, and everything in between. And I think the market's going, I'm not bullish because of everything that's going on with the administration, geopolitically, tariffs, etc. But I'm not bearish because the earnings picture is really, really good. Stocks are in a bull market. And that was really the story of this past week here in sentiment. The S&P 500 continued to make all-time highs, but there's definitely some concerning things under the hood that we do need to be aware of. And one of them is market breadth. Now, we can clearly see a negative divergence here, where stocks above the 200 days actually declining, but the S&P 500 kind of moves sideways. That is called a negative divergence. And often that does mean that will see the S&P 500 move down. However, there is nuance here. What you really want to see is stocks above the 50% mark. Anything above the 50% mark, whether the 200-day, 20-day, 50-day, any type of breadth momentum, if you have 50% of constituents above a select average, that is generally considered healthy. Nonetheless, we have seen longer-term averages come down from their highs, while the S&P 500 has traded flatline, and that could pose a little bit of risk in this market. And we have started to see that over the last couple of days. Any slight whiff of bad news or earnings, whether it's the fundamental side, the macro side, or even on the technical side, markets are selling off very viciously, and that really does pertain to particularly the valuation picture we're seeing right now. Nonetheless, if bears do want to see extended sell side, what they really want to see is leveraged ETF monthly flows tick up in a very big way. In fact, we saw negative flows here in the month of January, and we've seen a steady decline over the last couple of months until we actually get a big uptick here in ETF net inflows, leveraged ETFs. That is when we'll probably see proper downside, because it means there's a lot of margin being used and people are very, very bullish at the top. And then with inverse ETFs, it means that people are positioned ready to take advantage of any downside. So we're not seeing that just yet. Leverage ETF net inflows are sort of sanguine. They're so-and-so. I guess you could call it neutral. And until we actually see a massive change in this, I think the S&P 500 markets are going to continue to do what they've done over the last couple of years. And that's because things look really good. Profit margins are rising for stocks as a whole. For S&P 500 stocks, tech stocks, and even non-tech stocks, you can see margins are rising. That is very, very positive. And that probably goes to show that corporates over the last couple of years have really slimmed down their operations and starting to implement AI and starting to see underlying benefits when it comes to efficiency. We are also seeing earnings grow. Now, we talk about S&P 500 earnings on this channel a lot, but Russell 2000 earnings looking very strong. 51% earnings growth, 1.7% revenue growth, smashing the expectations coming into this earnings season, and margins looking rather good as well. This is the type of stuff you love to see. And guys, if you actually just remove the energy sector, you're looking at 3% revenue growth, 81% earnings growth. Now, 772 companies in the Russell have reported, so about 40%. So there's still quite a lot of earnings to go through, but this is the blended numbers. So earnings for the Russell 2000 looking very, very good, and expect this to continue for the next 4 quarters. If we do get this, the Russell 2000 is going to have a stellar year, and the market technicals also back this viewpoint up. After each 4-year time frame and price consolidation phase, as you can see on this chart, small caps launched higher in the years following, and relative valuations and earnings growth forecasts lend positively to this cycle repeating, if not simply rhyming. In other words, guys, get ready to load the boat in small caps because we could definitely see a move to the upside on the back of strong earnings, margins improving, and a greater rotation trade from large to small under the hood. Now let's actually go ahead and talk about the macro. So there is some concerning things starting to rear its head with the macro. One of them is actually the Fed's GDP. Now we've seen a steady downward move here in Q1 GDP estimates. While we are still above 2% and in line with the blue chip consensus, this is trending to the downside, and we don't really want to see this continue. If we continue to see Q1 GDP move down, that can be a very grim sign for the market. This market needs growth to be robust, especially with where valuations are right now. Now, another risk to this market could actually be rate cuts. You can actually see here that central banks globally around the world are on the verge of cutting rates. And while this is a boon for liquidity and stocks generally follow global liquidity, what it does mean is that inflation and prices as a whole could also tick up in a very big way. You can see that the amount of central banks whose last move was a rate cut, pricing pressures generally follow as indicated in this chart. So we could actually see a resurgence of inflation, and that could really wobble equities. Something else that we do need to be aware of is the housing market, how slow that's moving, and how it pertains to residential construction payrolls. Now, we look at this indicator quite often on this chart. It's a great parameter for the economy. It's also a leading indicator. And what we're seeing right now is the type of activity in the housing market. This level of activity combined with the current backlog, in other words, building permits, is not enough to sustain residential construction employment indefinitely. And 314 Research see here that even in a bull case, we should see residential construction payrolls move down in a very big way unless we actually see a material change in overall activity in the housing market. And this is part of the reason why I think the Fed is going to cut rates more than expected, because they're probably looking at these type of indicators and it's looking a bit grim. They're also probably going to see some deflation measures when it comes to rent growth. And I think that's going to pertain to a growth scare sometime in the spring, sort of the middle of 2025. And another thing we're also seeing, I showed you guys this yesterday, the spread between the CPI and PPI is officially negative, meaning that businesses are feeling the squeeze and they simply can't pass on the extra costs from inflation to consumers. And if we do actually get inflation rising, as well as maybe some of a labor market unwind, that is not going to bode well for the economy. So these are just some macro risks I'm seeing right now. Everything still looks largely good in my eyes. The labor market is good, growth looking robust, and this can turn obviously at any moment. However, these are definitely risks I'm paying attention to with regards to equities and what it means for our investment portfolios. In the year and now, guys, my stance is you still want to be long and you still want to stay invested. However, do be aware that macro risks are starting to perk its head up. Now, looking at earnings next week, guys, we have a huge week. Why? Because Nvidia is reporting. This stock is really going to move the market next week. We also have Home Depot reporting. That's going to move the staple component of the market. And then we have some big tech names as well. Salesforce, a $300 billion company. Intuit is a $160 billion company. We also have Lowe's, TJ companies. That's a $132 billion US company, guys. That's a very big company. American Tower Corporation, Dell, Synopsys, EOG Resources, Workday is also reporting, Autodesk, Snowflake, Vistra Corporation. So a lot of AI software names, semiconductor names are reporting. So yeah, sort of the software, hardware, the infrastructure components of the market, they're all reporting next week, at least some very notable names. So you're definitely going to see some market movers. We also have Realty Income reporting, Monster Energy, Public Storage REIT, Coupang, so Diamondback Energy, FANG. That's an energy stock I was looking at getting into at the start of last year. So some very big names, a lot of volatility going to come from earnings next week. So do be prepared. And then looking at high impact data next week, we only really have Thursday and Friday. We have durable goods, and then we get the GDP growth rate. This is the second quarter, the second revision that we get. We also get core PCE, as well as personal income outlays month over month, so personal income and personal spending. If we actually just turn it down to 2 stars, we do have a couple of data points here for the rest of the week. We have the manufacturing activity index, the Chicago Fed and Dallas Fed as well. Fed Barkin is speaking on Tuesday. That's about it. And then on Wednesday, we have new home sales year over year, month over month. Bostic has his speech, and then the 30-year mortgage rate. And then on Thursday, along with the GDP and durable goods, we also have initial jobless claims, pending home sales. So that's going to be very important for REITs and real estate stocks, and a couple of more Fed speakers. And then on Friday, along with the personal income outlays and the PCE data, inflation data, we also get retail inventories, wholesale inventories, and then Chicago PMIs. And then that's really it. So it's going to be a very big week of earnings next week, as well as a big week of data, guys. But if you've made it up until here, thank you so much for watching. If you liked this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.